Thank you all for joining us. As you've just heard, I'm Amanda Cantrell. I help run the U.S. investing team here at Bloomberg. And I'm here with Manroop Jhooty, the Senior Managing Director and Head of Total Fund Management for CPP Investments. Manroop, thank you so much for being here today.
Thank you very much for having me. It's my second year here, so fantastic to be back.
Great, welcome back. Well, we don't have a lot of time, so let's get right to it. I would first love it if you could tell us a bit about CPP and then your role within it and what total fund management encompasses.
Sure. So CPP, for those who don't know, or CPP Investments in particular, manages roughly $730 billion of assets on behalf of the CPP and the 22 million beneficiaries and contributors within Canada. Within the CPP, total fund management really has three main kind of pillars to its mandate. So I'll quickly go through those. The first is we're responsible for the portfolio design. So we do, in essence, all the research, the analytics, and the modeling that goes into all of our asset allocation decisions. So the decisions that are the backbone of our geography choices, our asset choices, all come from within TFM. The second piece of what we do is what we call the portfolio management piece. And really what that's intended to do is it's intended to ensure that once we've set those design targets, the total fund is actually getting as close as it can to those targets. So a lot of our investing teams will invest where they find the best opportunities, where they think they're going to get the best risk-adjusted returns. It's TFM's job to then take that bottom-up investing, compare it to those targets, and ensure that we are getting as close to those optimal design targets as we can. And then the last piece of what we do is what we call portfolio implementation, which really is around sort of ensuring the balance sheet is being managed prudently. We have the appropriate liquidity on balance sheet. We're managing all of the financing activities on behalf of the top of the house. And then we also do all the trading on behalf of the fund as well.
Right. So I know that you all are long-term investors, but I would like to talk about the short-term for the time being. There's a ton to navigate right now between tariffs, geopolitical risks, the U.S. fiscal situation. How are you, with that in mind, how are you positioning the portfolio now to take advantage of any of the dislocations and also avoid some of the pitfalls?
Sure. So, one of the things that we always kind of remind ourselves, but frankly, when we talk about the portfolio, remind others, is that we are a long-term investor. Our objective is to maximize returns on behalf of the CPP over the long term to ensure planned sustainability. That's first and foremost our investing philosophy. What that means is that when we design the portfolio at the outset, we're really trying to design a portfolio that is able to withstand multiple types of economic shocks and is able to be resilient through multiple cycles. It's not about setting up a portfolio that we think is going to be the best portfolio for the next 12 months. It's really about setting up that portfolio that we think is going to maximize returns over the long run. Now, when it comes to the current investing context, it doesn't mean we don't take into account what's happening in the market. We certainly take into account what we're learning and what we're seeing, but we tend to view it through the lens of what is the impact over the medium to long term as opposed to what do we think tactically is happening. A lot of the tactical things that happen in the portfolio, frankly, happen within our investing teams, the ones that are out there looking for investments in private equity or credit or in real assets, where they're really seeing the day-to-day opportunities from a bottom-up security selection perspective. From the top-down perspective, we're really more concerned about what are we seeing in the market today that perhaps changes some of our long-term views of what we think is, sort of the equilibrium between asset classes, between FX, between various risk factors. And so that's philosophically kind of how we generally view the world. When we're thinking about the current context, to actually get to your question now that I provided a big preamble, when we think about the current context, there's probably a few themes that are on our mind. That's probably an easier way to kind of tackle it because there's many things that are frankly happening. I think the first is AI, by no surprise. We are thinking about AI both in terms of the immediate investing opportunity, and that's not just thinking about sort of the specific things around the Mag 7, but it's really things that are adjacent to AI as well as those things that are explicitly AI, whether that's power or energy, infrastructure and data centers. Those are certainly an aspect of the market that we think provides significant opportunity, and you're already frankly seeing it in terms of the degree of CapEx that's going into the AI space generally. We are also thinking about the implications of the world moving away from globalism, multilateralism, to something that looks closer to bilateral transactional relationships between trading partners, and what that means not just for supply chains, but what it means in terms of trading blocks and where the opportunities are going to be, what the opportunities are as economies begin to sort of champion domestic champions, think about reshoring or friendshoring. What does that mean in terms of the risks and opportunities that come? And then the last piece of the kind of the core theme that we're thinking about is generally things around, let's call it the fiscal umbrella. And really, there's a few threads to it. Really, it comes down to longer term, how do we think about what's happening vis-a-vis fiscal deficits that are happening not just in the US, across the globe, and what does that mean for kind of our traditional views of assets, in particular, our traditional views of the role of fixed income in portfolios that has typically been a very important diversifier when you're constructing a portfolio. And do we think those same diversification benefits that we've seen in the empirical data will hold up in light of some of the fiscal challenges that we see? Right.
So what are some specific opportunities within those broad themes you mentioned, like AI and deglobalization, that you think are most attractive right now?
Yeah, I think AI on the one hand, I think it's to some extent it's really, there's a really interesting opportunity set around the adjacencies. I think there are constraints and limitations as it relates to power and energy that's going to be needed to continue to support the AI build out. The data centers themselves and the requirements for chips, I think, do create interesting investment opportunities that we haven't seen, at least in the more recent past. So that's one piece. On the fiscal side, I kind of referred to it more from a medium-term lens, but there is a short-term lens to the fiscal, which is between fiscal and the move towards, let's just call it more bilateralism, perhaps reshoring and friendshoring. There is a new impetus for fiscal to be used in nation building, and I think that creates a really, really interesting opportunity. You're seeing it in Europe. You saw Germany for the first time actually talk about running fiscal deficits to help support infrastructure, to help support defense. And we think those are really, really interesting opportunities for a fund like us that likes to deploy capital into infrastructure-like projects.
Right. And, I'm going to ask as a follow-up the flip side. What's making you nervous right now? Or at least what are you sort of avoiding for the time being or being cautious about?
Yeah, I don't think there's anything that jumps out that we're avoiding in this market. And what I really mean by that is there's nothing, obviously, where we think that there's excessive risk in the market. We are, in all these things, being cognizant of the overall macro backdrop. So in one sense, you have a great degree of tailwinds as it relates to the CapEx and investment that's happening vis-a-vis AI, as well as the fiscal stimulus that we've been talking about. But you kind of have to look at the flip side of the macro equation, which is some of the headwinds that we see. And so we're starting to see some of the headwinds around sort of weakening labor markets, perhaps a bifurcation of the U.S. consumer, as an example, where upwards of 50% of consumer spending is actually being done by the top 10% of the consumer. And so you have, at the same time, you have these tailwinds. There are headwinds, and you need to be mindful of those headwinds. Because it's not just, in many cases, it's really a balance between, do you think it's the tailwinds or the headwinds that are ultimately going to dominate the investing landscape? And that's really the approach we're taking, as opposed to staying away from particular markets or assets.
Great. And shifting gears a little bit, we talk a lot about private market investing here at Bloomberg. You do a lot of both public and private market investing. How do you decide which approach to take for a given asset class, and how do you sort of adjust and rebalance when, say, the returns for public markets in one asset class appear to outstrip private and vice versa?
Yeah, so when it comes to the design aspects of it, what we really try to balance between being public versus private is ensuring that we have enough liquidity on balance sheet, not just to meet liquidity needs, but to have enough liquidity on balance sheet to be able to move to where the opportunities are, to be able to rebalance your portfolio, and ultimately be agile in a market that provides risks and opportunities on an ongoing basis. And that balance is really trying to find that right level of public market investments to create that agility while still ensuring we are deploying into the private assets that we think, at least from our own track record, have significant excess returns across private equity, credit, and real assets, that we want to ensure that we're deploying the right amount of capital to continue to generate those alpha and excess spread opportunities. But it's really about finding that balance from a top-down asset allocation standpoint. When we think about what's happening day to day, it really comes down to a question of how do you assess relative value. And it's an area that we spend a lot of time on in terms of assessing private transactions versus what we think the public market alternative is. So that we're always challenging ourselves, not just thinking about what's the headline IRR of a specific transaction, but trying to decompose that IRR to what do we think is, how much of that is systematic, how much of that is true security selection and alpha, and how does that compare to what we can do in public markets, which provide a greater degree of liquidity. And it's that relative value discussion that I think becomes critical. And it's fundamental to how we think about investing, where it's not just you have X amount of capital, go and deploy it. It's really about where is that capital ultimately best deployed. And having that relative value lens is important to think about the day-to-day trade-off of what you do in public versus private markets.
Right. I'd like to drill down a little bit on private equity. We've been writing a lot about the difficulty that some private equity firms have had. Well, a lot of them have had selling their portfolio companies, getting distributions back to investors. We noticed that you all reduced your private equity exposure slightly in the last fiscal year to 21% from 25%. How are you all thinking about private equity now?
So we're very comfortable with our private equity allocation where it is around 21, 22%. The reduction that you were referred to, I think, is perhaps a little bit of a construct of what I'll describe as market dynamics. I think coming out of COVID, opportunities to dispose of assets through traditional channels, whether it be IPOs or sales to strategic or what have you, were limited for generally the private equity universe. We're starting to see some of that turn back on. And so you saw a natural growth of private equity in the portfolio as a percent of the portfolio being more reflective of market dynamics than anything else. It's not us reducing from 25 to 22 because of a view on private equity. It's frankly a consequence of what we're seeing from a market standpoint. But we do think where we are at 21, 22% is appropriate.
And we talked about public versus private. I'd like to ask a similar question in terms of direct versus indirect. How do you decide when to outsource and when to invest in-house?
Yeah, when it comes to direct, we have to continue to believe that when we go direct, we are doing so because we believe we have some form of edge. If we don't believe we have edge, we shouldn't really be going direct. But what's really important about that direct indirect is that even when we go direct, going direct doesn't mean you go alone. And in many instances, we're working very closely with our partners across capital markets, in particular our GP partners in the private equity and real asset space. We're partnering with them to find those opportunities and working closely with them to originate transactions, structure transactions, and ultimately execute. But the beginning principle is that we go direct in asset classes and strategies where we genuinely believe we have edge.
Okay. Well, I think I have time to ask you one more question. So I feel like this being the Canadian Finance Conference, I'd be remiss if I didn't ask you how you're thinking about investing in Canada.
So we are very bullish about investing in Canada. The backdrop is one in which we're starting to see strong momentum and a galvanization of political will to kind of consider major projects and nation building in a way that we hadn't seen before, and we're genuinely excited about the opportunities that presents, particularly for an investor like CPP, and we're bullish about that prospect. We're interested and engaged in those discussions, and so we're very excited about the prospects. So we have a significant portfolio in Canada, and we'd love to be able to add to it.
Great. Well, I think that pretty much leaves us with not enough time to ask another question. So really appreciate you taking the time to be here. And yeah, thanks very much.
Great. Thanks very much, Amanda. Thank you. Thanks.